The German Asset Managing Real Estate GmbH, German Real Estate Investment Series 04. Corporate taxation, the extended trade tax reduction and activities that may jeopardize it. For an international investor building a German commercial property portfolio, the Asset Managing Real Estate GmbH can be an important investment vehicle. It is commonly referred to in German as a vermögensverwaltende Immobilien-GmbH or VV-GmbH. However, it is not a separate legal form. It is an ordinary German limited liability company whose activities are structured around holding, leasing, and managing its own real estate. Its main tax attraction is the potential application of the extended trade tax reduction. If all statutory conditions are satisfied, qualifying income from the management and use of the company's own real estate can be removed from the trade tax base. The company remains subject to corporate income tax and the solidarity surcharge. This advantage comes with strict conditions. An apparently minor additional activity can affect the company's eligibility and create an unexpected trade tax burden. Why use a real estate GmbH? A German real estate GmbH may be suitable for an investor who intends to hold commercial properties for long-term rental income, reinvest profits in further German properties, separate real estate from other operating businesses, introduce additional investors at company level, organize financing and liability for individual assets, build a portfolio that can later be transferred or sold through company shares. For a larger investor, the GmbH may become part of a wider German holding structure. Individual properties may be placed in separate subsidiaries to isolate financing and liability risks. The detailed design of such a holding structure will be covered in Article 6 of this series. The GmbH is always a commercial enterprise. A GmbH is treated as a commercial enterprise for German tax purposes because of its legal form. This applies even if the company merely owns one building and collects rent. Unlike a private landlord, the GmbH does not generate private rental income. Its profits are generally subject to corporate income tax, the solidarity surcharge on corporate income tax, trade tax. The corporate income tax rate is 15% through 2027. The solidarity surcharge amounts to 5.5% of the corporate income tax. Under legislation currently in force, the corporate income tax rate is scheduled to decrease gradually from 2028. Trade tax is determined partly by the municipal multiplier applicable at the company's business location. Without a special reduction, this can substantially increase the company's total tax burden. The extended trade tax reduction. A company that exclusively manages and uses its own real estate may apply for the extended trade tax reduction under Section 9 of the German Trade Tax Act. Where the requirements are met, the part of the trade income attributable to the management and use of the company's own real estate is deducted from the trade tax base. In practical terms, qualifying rental profit may therefore avoid trade tax. Corporate income tax and the solidarity surcharge continue to apply. This is not a general tax exemption for the company. Income from activities outside the qualifying real estate management may remain subject to trade tax. The reduction must be requested and its requirements must be satisfied for the relevant assessment period. What is meant by own real estate? The company must generally manage and use real estate that belongs to it. A typical qualifying activity is the long-term rental of a company-owned office building, warehouse, retail property, or residential building. Merely managing properties belonging to other persons or affiliated companies is different. Third-party property management can constitute an additional commercial service and may jeopardize the reduction. The distinction is especially important in a group structure. A property company should not automatically perform administrative or management services for the other property companies in the group. Such services may be better provided by a separate management company. Permitted activities are narrowly defined. The statutory rules permit certain activities in addition to the management of the company's own real estate. These can include the management and use of the company's own capital assets and certain specifically permitted housing-related activities. The law also contains limited exceptions for electricity generated from qualifying renewable energy installations, electricity supplied through charging stations, certain services provided directly to tenants, These exceptions are subject to statutory revenue limits and additional requirements. Under the current legislation, qualifying electricity-related revenue may generally remain harmless up to 20% of the revenue from the use of the real estate. Certain other direct tenant-related revenue is limited to 5%. These limits should not be treated as general permission to conduct unrelated business. Each activity and contract must be reviewed separately. Activities that may jeopardize the reduction. Particular caution is required where the company performs activities beyond simply leasing its own land and buildings. Potentially problematic activities include managing real estate belonging to third parties, providing broad facility management services, operating a hotel, restaurant, or other active business, offering extensive services to tenants, trading in goods or other investment assets, holding unrelated movable assets for investment purposes, providing services to affiliated companies, leasing certain machinery or business equipment together with the property, conducting systematic property development or trading activities. The German Federal Fiscal Court has confirmed that even an activity generating no current revenue can be harmful if it is not among the permitted activities. The company's articles of association alone are not decisive. What matters is what the company actually owns and does. The problem of fixtures and business equipment. Commercial properties often contain technical installations, machinery, or other equipment. Not everything permanently connected to a building qualifies as real estate for German tax purposes. Certain installations may be classified as business equipment, Betriebsvorchungen, rather than part of the property. Examples can include specialized production equipment, cranes, certain lifts, or installations serving a tenant's particular business. Leasing such equipment together with the building can jeopardize the extended reduction. A narrowly defined exception may apply where the additional equipment is an indispensable or functionally necessary part of an economically meaningful use of the company's own property. However, the requirements are strict and fact-specific. The equipment included in a commercial lease should therefore be reviewed before the agreement is signed. Long-term rental versus active property development. Selling a company-owned property does not automatically prevent the extended reduction. A sale can still form part of managing and using the company's own real estate. The risk increases where the company repeatedly acquires, develops, and quickly resells properties or provides substantial development services. A company acting like an active property trader or project developer should not simply be treated as a pure asset managing company. Larger investors may therefore separate long-term rental properties, development and renovation projects intended for sale, operational management and service activities. Placing these activities in separate companies can protect the tax profile of the long-term property companies and isolate commercial risks. A practical example. Suppose an international investor establishes Berlin Office Property GmbH to acquire and lease a commercial building. The company owns the building, receives rent, and performs only the activities necessary for managing that property. If all conditions are met and the extended reduction is properly requested, the qualifying rental profit may be removed from the trade tax base. Now assume the same company begins managing buildings belonging to other investors, provides extensive facility services, and leases specialized machinery to tenants. These additional activities may jeopardize the extended reduction. As a result, the company could face trade tax that was not included in the original investment calculation. The potential loss of the reduction should therefore be considered before introducing any new source of revenue. Financing and deductible expenses. The company may generally deduct expenses connected with its rental business, subject to the applicable tax rules. These may include interest on property financing, depreciation of the building, maintenance and repair costs, property management expenses, insurance, professional and advisory fees. However, German interest deduction restrictions, transfer pricing rules, and conditions for related party financing may apply. If a foreign parent company provides a shareholder loan, the interest rate and other terms must be commercially justifiable and properly documented. The extended trade tax reduction does not replace a complete financing and tax analysis. Retaining and distributing profits. One advantage of a corporate structure is the ability to retain profits for future investments. After paying corporate income tax and the solidarity surcharge, the company may use the remaining funds to repay debt, renovate the property, or finance another acquisition. If profits are distributed to the shareholder, an additional level of taxation may arise. For a foreign shareholder, the result depends on German withholding tax, the applicable double taxation agreement, whether the shareholder is an individual or a foreign company, taxation in the shareholder's country, any available treaty or participation relief. The tax burden inside the property company should therefore not be confused with the investor's final tax burden after distribution. Practical safeguards. A company seeking the extended trade tax reduction should maintain a clearly limited business purpose and review every additional activity before it begins. Practical safeguards may include keeping long-term properties and development projects in separate companies, using a separate company for third-party management and services, reviewing equipment before signing commercial leases, separately recording permitted ancillary income, monitoring the statutory revenue thresholds, examining related party agreements, reviewing planned property sales in advance, applying for the reduction correctly in the annual tax return. The structure must also be observed in everyday operations. A carefully drafted company agreement cannot protect the reduction if the company conducts harmful activities in practice. The extended reduction should be planned before acquisition. The tax concept should be established before the property is purchased and before the main lease and financing agreements are signed. A later transfer of the property into another company may trigger notarial costs, land register fees, financing problems, and German real estate transfer tax. It is therefore important to determine in advance whether the property will be held or developed for sale, which equipment will be leased with the building, which company will provide tenant and management services, how renewable energy installations will be operated, whether additional investors will participate, how the acquisition will be financed, how the property or company may later be sold. The extended trade tax reduction is valuable, but it should never be assumed without analyzing the actual investment and operating model. Conclusion. The German asset managing real estate GmbH can be an effective vehicle for holding and leasing commercial property. Its principal attraction is the extended trade tax reduction, which may remove qualifying rental profit from the trade tax base. The company nevertheless remains subject to corporate income tax and the solidarity surcharge. The benefit depends on strict compliance with the statutory requirements. Third-party management, operational services, unrelated assets, business equipment, and active property development can create significant risks. For a larger international investor, the safest approach is often to separate long-term property ownership from development, trading, and service activities. The correct structure must be established before the property is acquired. It must then be protected through appropriate contracts, accounting, and ongoing tax review. This article provides general information and does not constitute individual legal, tax, financing, or investment advice. The extended trade tax reduction depends on the company's actual assets, contracts, and activities, and must be examined for each individual case.